All right. Hi, everyone, and welcome to the TimingResearch.com crowd forecast news for September 23rd, 2024. We are recording this at 1 p.m. Eastern Time, and this is episode number 448. So my name is David Kosmeter. I'm the creator of TimingResearch.com, and you should be seeing my charts and screen right now. And I'm also joined by the option professor today, and he's going to share his charts and ideas in a few minutes. But we're going to start out with something a little different today. I'm going to show some charts from this tool that I've been using for a couple of years now called Seasonax, and it's a really interesting way to visualize seasonal patterns on different stocks and indexes and commodities, currencies, all sorts of things. So we always start out talking about the S&P 500. So historically, this is what it shows for this week for the last 15 years. Only 33% of the time the S&P 500 has gone up during the times of or during the days between September 23rd and September 27th. And you can see historically all the performance here. And then also this chart, this section, or this setup shows the S&P 500 over the last 25 years just on election years. So you can see that historically, you can move the slider here, and it shows a visualization of that the market has been historically down going into elections and then bounces up immediately afterwards. Only over 80% of the time. And then you can also see individual stocks as well. So like here's an example, UNH. Between the periods of September 26th and November 8th, for the last 10 years, this stock has actually gone up 100% of the time. And again, it has all these tools for showing exactly what the pattern is and history for each chart that you want to look at. Another interesting one is Russell 2000. The late October to late November, it's actually gone up. The Russell 2000 has gone up 100% of the time over the last 10 years during this period. And it even shows an annualized return, so 92% return during this period. And again, you can look at all the individual past years that way. And then I'll just show one more here. This is the interesting anomaly. So for the last 15 years, gold historically during the early September to early October period has been down almost every year during this period, except 2010 and 2012. But of course, we know this year it's had a big jump during this period. So, but this is an interesting tool for finding seasonal patterns, and then you can watch for a trend and see if the current charts are matching up with what's playing out during the current year. So again, that's called Seasonax, and you can check that out. And Jim, do you have anything else that you want me to show real fast?
Did you have something with crude oil?
Oh yeah. So it provides this quick list of common commonly looked up commodities and indexes and everything. So yeah, so crude oil for the last the last 15 years again. And you can set it on, there's a lot of different options for what time periods you want to look at. So from this week through, say, mid-October, oil has gone up about 60% of the time, but then it starts a general downtrend after that, and looks like mid-October till, say, mid-December are typically more of a downtrend most years.
And US dollar?
See, that's on the popular ones too, US dollar index. So it looks like, yeah, from around now until mid to late October, there's a downtrend in the dollar historically, except for a few years there. And this is the up percentage, so only 27% of the time it went up during that period, approximately. And then looks like there's a uptrend that starts in late October and goes to late November. So almost 73% of the time went up during that period.
And you said you had the small caps, IWM, I guess?
Yeah, Russell that I talked about.
Yeah, Russell is
Um,
IWM.
yeah, or I could change. You can change it specifically to the
IWM.
IWM, and then there's some that go back 100 years or so, but yeah, IWM you can do 24 years if you want. So again,
When's that big up thing start?
um, so there's this little bump here that's like
In
mid-October,
October.
and then
It seems like some of the things go down in October, and then they have that nice end of year Santa Claus rally. It seems like that's what's going on a little bit.
yeah,
So it'd be interesting to see if the charts are saying a dip now and then rally later kind of thing.
there's a lot of you can see it in the S&P 500. Um,
What about in the semiconductors, SMH, that would be all the NVIDIA kind of guys and all that.
yeah,
Yeah,
that's
so
a
it's
bottoming out too.
bottoming out as we
And
go
then
into the middle of October.
yeah, and then you
Near the
move
end.
into the Santa Claus rally where
Yeah.
everything well, or a lot of things tend to go higher
Yep.
most
Yeah.
years at the end of the year.
So the question is do we get a pretty sizable drop here in the next few weeks before that turn may happen or not? And then we looked at the oil, we looked at the gold, we looked at the UNH, IWM. And I wonder if FXI, let's see what some of the international markets, because that's something I've been very happy with in the last week or so, is the turn in the China stocks.
Hmm.
Classic case of, things are bad in China and everyone's assuming that it'll never change. And of course, that idea is pretty silly because things always change at some point.
Yeah, it looks like um, FXI kind of holds that pattern too. See,
Mhm.
bottoming out in, well, it has it more in early October and then drifting higher most years until early November.
Gotcha.
And then it's, kind of all over the place.
Yeah, then as you go into the end of the year, it falls off a cliff sometimes. And
Yeah.
what is the statistical um, percentages on the rally between, the November, December timeframe? Is that a pretty
or
high probability? Or
FXI.
yeah, because
Uh,
that's thing just starting. I mean, if there's a big rally ahead, there's plenty of room to go.
for this period, you mean?
Yeah,
Yeah, so that's yeah, over 73%
yeah.
from early October to early November.
All
So,
right.
yeah, that's a pretty good pattern. And even the well, see, and then like I said, you can go to individual years.
Uh-huh.
So 22 was bad in that time period, but even the other
There's, yeah, there's a couple of other ones I'm really happy with this week and last week. Freeport McMoran FCX. You know, that's another deal where if China turns, there could be demand for the copper, and then bingo, bango, bongo. I don't know if that's a technical term. I just came up with it. Bingo, bango, bongo.
right. Um, yeah, so yeah, early October to early December is
Yeah.
67% almost.
How about Newmont Mining? Another one of my pals lately, NEM. So
Yeah,
that's similar to the gold. It kind of languishes a bit, huh?
yeah, it's kind of all over the place.
Yeah. So the industrial metals seem
Let's
to.
go. Let's try this period. Okay, so yeah, that's a very strong pattern. Only two of those 15 years was it up during mid-October to late November.
Hmm.
So
And I wonder what like some of these gaming stocks, like an MGM. You know, it's football season. People are going nuts with the gambling. MGM, yeah. Just thinking of some of the different sectors, you know, that might be going someplace
yeah,
during. That's a pretty,
this
yeah.
this red line always shows today. You can turn it off or turn that off and on here.
Uh-huh.
Um, then you can move the starting line basically. So if you want to look at the trend all the way to February, it's a very strong trend on MGM all the way through early next year. Or you can set it to this peak. See, that's almost 87% win rate.
Yeah. No, people, as you know, the season starts, they start gambling and this and that, and you know, was wondering. Let me think of something else. You got the Freeport, then you got them. Well, how about these banks? Like Bank of America, BAC. They got earnings coming out on October 11th, and
Yeah, that is kind of a similar one through early next year. So 80% from early October to mid-January.
I'm not unhappy to hear that. What about some of the big guys like Apple?
Yeah, that one's actually in season. There's all these popular ones here.
Yeah, well, you would think it might be seasonally good here because people buy the Christmas presents, but it doesn't look very good on that one.
Yeah. Um,
Maybe they don't buy it.
early, so throughout the most of the month of October,
Yeah.
there's a historically a strong bump in price there, but then yeah, it looks like
Like it has a big summer rally or going into the summer rally, and then and then I guess right in is that the January effect? Can you see the bottom way over here? Is that January? I can't see it. Could you move the chart up a little
yeah.
bit?
So
Oh, there it is. Yeah. So there's a January effect thing here, so that's something to keep in mind.
yeah.
Yeah, because that's people loading up for the beginning of the year. You know.
Hmm. But yeah, this oh, see, this is a one of these interesting situations too, where um it looks like a downtrend on the visualization of every year.
Yeah.
But then if you look at the actual winning years,
It's
it's
50-50 pretty
six,
much. Yeah, yeah,
yeah,
60.
it's 60%, but you can see that on the years that were down, they were pretty big, relatively big down years. So it makes the whole time period look like it was down.
IBM's, just really been like the ever ready bunny. It just won't stop going up. So what does that look like going into the end of the year? Yeah, similar to the gaming stock. Oh, yeah. So it bottoms out in October. Well, it has a kind of
Yeah.
big drop in October, but that's already kind of behind you. And then it has a pretty good advance to the end of the year.
Yeah. Um, yeah. So this is actually
And that
through,
86 is a pretty good number, huh?
yeah, through uh through February. So
Yeah.
all of
Well, I think we said Google and IBM look pretty good going into the end of the year. Oh, and those the Bank of America look pretty good to the end of the year. Um,
Google is,
Now, yeah, what about transportation? What about consumer discretionary? So we put XLY up there. That's kind of like a one-stop shop. Can that tell us how the consumer does these stocks going into the end of the year?
yeah. So let's see. That looks like a good trend. Yeah. So 93% out of the last 15 years from
Yeah.
early October to early December. And then let's see what happens here. It's still up, but there were some big down years during that period too. But yeah, this trend looks, or this period looks really nice right here.
Has Tesla been around long enough to have
Um,
the data?
let's see.
That that's been trying to get on its bicycle, and they say autos do pretty good when they cut the rates. So that would be something to consider.
Yeah, yeah, it looks like hmm, yeah, 14 years. So it's,
Of course, really, it's had most of its action in the last 10, right? Right.
yeah, yeah, yeah. Um,
So kind of
yeah,
sticky going into the end of the year historically,
yeah,
and then it goes from there.
yeah. Um, yeah, kind of choppy in some of these years, but yeah, there's a bit of a seasonal uptrend through December. And let's see.
Well, it certainly looks like the consumer and the gambling do pretty good, and the banks do okay. And those are three right off the bat. And then I think the small caps weren't too bad. And then UNH was pretty good. So
Hmm.
we got enough to chew on. We'll see what the real world's doing. Of course, you did throw out the disclaimer that past performance is not indicative of future results. So I'm sure you did
Of
that already.
course,
Yeah.
of course, yeah. Of course, yeah. These patterns are not obviously set in stone. It's just a guideline for what has happened in the past and what
Yeah.
might line up with charts going forward.
Yeah.
So, if anyone is interested in learning more about Seasonax, you can go to TimingResearch.com/season or TimingResearch.com/Seasonax, and you can find out how to get access to this tool. It's like I said, it's been something really interesting that I've been using for a couple years now. So I wanted to start telling more people on the Timing Research show about it. So,
Sure. Sounds
all
good.
right.
Oh, can I share my screen now? And we'll get into some of the more
Yeah,
temporal stuff, the temporal stuff, the stuff that's here on Earth.
right. Yeah, you should be able to share now.
A second here. Share this, share that, and boom, boom, boom. How we doing?
All right, it's loading. Okay. Yeah, I see it now.
All right, guys. So, and again, if you have any questions, you can put them in the chat box, and we'll try to hit them for you. So, if you have a stock you want me to talk about or look at or give you an opinion on, again, by way of introduction, I'm Jim, the option professor. I've been doing this investment arena here for decades. I've done seminars throughout the country and Canada on the uses and risks of options for many decades. So I'm pretty familiar with options and I'm pretty familiar with the markets. I'm going to share with you my opinions today and my observations. But of course, there's no advice given, only ideas that I'm sharing. Okay. And so let's take a look here, and we'll start out with the S&P. And I'm going to show you how basically I'm looking at it. I start out on a 20-year basis so I can see the reality of what QE did. They started doing QE in 2010. So if you want to know how it looks like that, it's called expanding money and credit and keeping interest rates at zero almost for 10 years. That's how you get asset prices to look like that. And of course, they increased the balance sheet from 4 trillion to 9 trillion during COVID. So there you go from 2000 and really hyperspace it all the way up here. And now it's time to tighten our belt, he says, right? Inflation is licked, and we're going to go over and try to make sure unemployment doesn't go up. Well, I'll tell you, he's got a reason to be nervous about unemployment because 2/3 or 70%, something like that, of our GDP is based on consumer spending. And if you have prices of these things up in this neighborhood, the consumer had better keep spending. And they can't spend if they lost their jobs. So the Fed thinks that the unemployment rate, which is at 4.2, won't go much higher than 4.4. That could be wishful thinking. Why? Because the hiring rate is drying up to 2014 level. Why? Because the JOLTS, which is how many jobs are open for every seeker, has gone from way over 2.2 to 1, and now it's around 1 to 1. So that's pretty good collapse. They did take out 800,000 jobs from the jobs report. They said they made some kind of a mistake. So not only has the jobs market not been as good looking backwards, but there's reason to think that there's some risk in it going forward because, well, the surveys show no planned layoffs. That can change. And of course, the temporary help has been cutting down. So, sometimes this thing works in stages. First, you stop hiring. Then you cut your temporary help. Then you obviously, the next step would be to start cutting your real help or cutting hours back. So hours worked might change. And anyway, the trend on that's not so great. And so basically that's a big risk. And why is it a big risk? Because earnings are really, really expected to be fantastic. Now in Q2, earnings were up 11.3%, I read. And this quarter here, they're only looking for up 4.9%, which was a reduced estimate. Next year is supposed to be happy days are here again, because they're looking for a 15 to 18% jump in earnings growth. And that's a pretty big jump. Now, you also got the PE ratios, and you've had a big advance. I mean, going into this Fed cutting, we went up about 27% in stocks, and the PE ratios are like 22. And so, it's a fully blown up balloon here that is going to need two things: consumer spending, and it's going to need earnings. Now, I said in my update that I hand out to my subscribers that if you need an explanation of what happens to stocks if they miss their earnings, you only need 2 words, not even 2 complete words: FedEx. As you see on Friday, I'll show you just for sake of illustration here. FedEx announced that they're not making quite as much money, and they don't think the future is quite as bright. And so it had a pretty good sized drop here on Friday, where it went from the 300 area down to 255. Had a bounce here, thank God. But that's a pretty good wake-up call, huh? Like if you had 1,000 shares of this, it's 310 grand, and then by the time you had coffee the next day, it was at 250 grand. That's a little bit too much volatility for many people. And where could it catch? Well, here's the deal. This is where you start looking for where it might stop. So where could it stop? Could stop in the 240, 238 area, right? Or it could go down to purple, which would bring you down to 208. Or it could give you the full Monty here and bring you down to 150 bucks. So that's where the elevators could stop, right? And also, if you compare the highs here, you were at an RSI of 73. You made a new high with RSI at 65. That's called divergence. That means it's running out of steam. And then it comes all the way back down here. Here we had a high point of 65 on the RSI, about 66. And here at this high point, it is only at 60. Again, ran out of steam, and now it's coming back down. Here's where it could stop, and there where it could stop, and there where it could go. So that's a lot of volatility ahead, possibly on FedEx. But it wouldn't be unlike the last time it had a big drop, because it had a pretty good size divergence when it ran up here. Not a huge one, but enough to get concerned about. So anyway, for those people holding FedEx, those would be some of the numbers. On my 5-year graph, another number here again would be the 230. What is it? 230, 235. So I don't see any fantastic reason why I would stop here. And this is what it looks like in on a shorter term basis on showing this the year. So anyway, that's the story on FedEx. I'd like to also go over the markets here and give you a little bit of what I'm thinking here. You don't fight the tape, you don't fight the Fed, but you always got to have your antenna up. Like I was telling people, when everyone's doing one thing, that means somebody's on the other side of the trade. Now, like August 5th, we dropped like how many points? We went down to 5,100 about on S&P. Now, the public's probably not buying on that panic, right? Who's buying is the market makers, like the Citadels, et cetera. And when you get a melt up on the upside and the prices are raised tremendously, who's selling into that environment? The public? Probably not. So the market makers are on the side of the thing. So a lot of times you may find that on a short-term basis, when you get order imbalances, you'll get extreme prices. And you get extreme prices because the guys on the other side of the trade, the market makers, they don't want to put their money up until they feel like the price is pretty safe to do it. And that's why you get, in other words, when they announced these bad earnings on FedEx and the entire planet was selling, market makers were doing a shot down here. Now, if you notice, there is some high points here of what? 253, 255, 256, right? Right? 257. Guess what? It stopped in here at around 250 something, and it's bouncing. So there's a reason why it's bouncing. It's because former highs are sometimes support. Okay? And then this thing here looks like a big island key here, right? Because look, you got a gap there that never got filled. Still hadn't gotten filled because you gapped right over it. So this thing here, 275, that area here, may be resistance now. And also, like I say, if it can't get back into the game here, longer term trends might take over. And maybe, but again, it doesn't look that bad on a long-term trend. It looks like a pullback right now. That's what it looks like as a pullback, if you're looking at the long-term numbers. So when the whole world is selling and market makers are buying, sometimes it's time to, and you can see here, there's all those former high points, right? And where did it stop? Right there. So if it was going to launch a bounce back rally, this low yesterday of 253 is a logical place where it might try. Okay. All right. Let's go back to the S&P and let's see what the big. I'm going to go over all the indexes here so you can see what things are going on. Okay. S&P. Okay. I like to start out with the big picture and move in. So here's the big picture. Big picture is you are in a big uptrend, right? And you are also way overbought. Why overbought? Because you're very far away from the red line and you're very far away from the green and blue. And you're miles away from purple, okay? Also, the RSI up here has been at, I think, 75. Now we've made all this big new high and the RSI is still in the 70s, right? So that is a tiny bit of inversion, not much. But again, it's tough to start buying something that is on its all-time high. The better time to buy is when it corrects back down to the moving average and you're buying closer to the mean. This is called reversion to the mean. And at some point, this thing is going to revert to the mean, I think, at some point. All right, on the 5-year, Nice trend. See, there's your opportunity to get in right there. You see, why do you think those market makers were happy to buy when everyone was selling at that level? Because there was a technical reason to do it. Why would the market makers be willing to buy a 253 yesterday on FedEx? Because there was a technical reason to do it. So right now, again, you're back up here. And where's your RSI here? 64 up? Nope. There you go. 77, 77. And then you go up to here. And where are you here? You're 64. So is that a divergence? Yes, it is. Does that mean the market may be running out of steam? Yes, it does. Is there evidence the trend turned down yet? No, there's not. Let's go to the 1 year. Again, let's look at this. You got high points here, 76. You got high points over here at 60. Nice little drop. Now you got another brand new high up here in the 60s, okay? But it's still lower than way over here. So some could argue that it is running out a bit of a steam. Now these two things at 5,600 are very important because they're pointing up, which would mean it looks like you could blow off to 6,000 on the S&P and it wouldn't surprise anybody. That's possibly true, okay? But if it started to roll over under 5,600 and these lines turn down, then that would basically establish that this was a rally made of lower strength and that it basically was designed to take out everybody's stop and get everybody long on a breakout after the Fed made their announcement. And then, of course, if it has a correction from here, these are some of the levels that it could pull back. But you can't deny the trends are up on all this stuff, no doubt about it. And that the path of least resistance is to the upside. And going to 6,000 is not off the table. So that's why I'm saying is that, this is just telling us that the market lost a little steam. You go to 5,900 and obviously these numbers will have no problem confirming, okay? On a 1 month graph, let's see what you got here. So again, you have some evidence that the market has run out of steam, right? You have some evidence. Well, I mean, I do. These are all my opinions. These are my indicators. I'm sure between the Bollinger Bands and the Gann lines and the MACD, there's 9 different things going on. I'm giving you my opinion and my views. So I have a thing in the back of my mind. This stock market has lost some of its legs, okay? I am now looking at the high point here of 74, and then this thing's at 67. It is running out of steam. But do you see the red line pointing down? No. And you know what? I don't want any part of the sell side until the red line starts pointing down, because you can't go down without the red line pointing down for any length of time. And if you're going to get a big move, like from 5,600 to 5,400, generally all my lines will be pointing the same way. See up? All the lines pointing the same way. So you're not going to get a big sustainable drop until we get these things over, which could be after the election, because moving averages, obviously, they're based on time and price. So one day isn't going to turn them around totally. Even when we had the big drop, let's look at the 1 year. Even when we had the big drop here, but again, you had the red line turning down, right? So you had evidence of a turn, evidence, and it was breaking the lines, evidence, right? Then you had this silly rally here that should be investigated. What the heck did it rally up there for? When the averages are pointing down and it rallies, good likelihood it's a baloney rally and you don't want to get sucked in by it. Because if this thing's pointing down, penetrating the line is just whatever it is. It's not changing the trend, okay? So right now the trend's up, okay? But I am concerned about what? The weakening of the momentum. And when would I be more concerned? Like I told you, if you get under 5,600 and you can bend these things to the downside, that would be more worrisome. Otherwise, the worry is that the FOMO crowd, fear of missing out, anybody who might be shorting it, or just speculators. If we go and we keep going here, PCE comes out on Friday. Okay, if that thing is really low and it looks like the Fed's going to cut another 50 maybe as a surprise deal again, this thing could be on its way. All that stuff I talked about employment has not happened yet. Okay, so what we know right now in employment is it's 4.2 and everybody's working. What we know right now about unemployment is everyone's wages have been going up. What we know now about retail sales is that people are out there spending their money. How do you know? Because the savings rate's at the lowest level like ever. And credit card balances are up 48%, I read, since 2021. Now the defaults are picking up 9%, so obviously somebody's not paying their bill. But on balance, GDP was just increased by the Atlanta Fed. So on balance, things are fine. And the talk about labor problems and inflation could go back up and earnings may be a problem. That is conjecture right now. What we know is what we know. So, like I say, don't fight the Fed, don't fight the tape. But keep an eye on it because things do change. So anyway, that's what the S&P looks like right now. And I'll go over a couple other ones quick. Let's look at that QQQ. You guys are in the NASDAQ, right? So let's take a look QQQ. Okay, 20-year basis. I don't think this thing goes back very good. Let's go to 5-year, better data. Okay, so there you have a high point that has not been taken out yet. This thing looks a little bit more shaky. Now here's the reason. Well, let me show you some things. I've never done this before, and some of you guys could probably use a little information like this. Let's go here. Long-term trends. And I'll go back. I'll come back to this. Look at some of these things that I look at from time to time. You might find them kind of interesting. Okay. All right, the Buffett indicator. You heard of that one, right? That's where you take the market cap to GDP. It tries to tell you if things are overpriced, underpriced, or fair priced. Well, take a look at this baby. This is going back to 1970, right? And this is the 2021, where we know that was an excessively high price, right? And so now we're right back at that level again. So that gives you an idea that the valuations are very high. And look, this was .com. Hey, .com looks like a little kid brother compared to what we got going on now. So when people say the valuations are a bit high, there's your evidence that the valuations are a little bit high. Okay, now I go over and I'll show you some other stuff. Stocks versus bonds. A lot of people think bonds is the place to be. Stocks returns are going to be kind of weak. Well, this is the high on .com, and look at the high there. Now get this. When did it peak out? It probably peaked out in June, July. A lot of things peaked out in June and July. This was one of them, meaning the ratio between the S&P and bonds has been more favorable to bonds since July. And that is an excessively high price. So that's probably the evidence they're looking at that says that the stock market may not outperform bonds. Let's go look at some other things. Imagine how long it would take us to do these statistics. God bless America, right? Okay. Let's look at value and growth. This was one I caught my eye. Since June, what has been happening? Well, look at that. Here's .com again, the little kid brother, right? Look at that. Of course, all of this is quantitative easing and print, and print, and print. Okay, so that's why it looks like that. But at any rate, there you go. So now you were up here on 2021, and look what growth did. It went all the way up here in June. But what happened? That relationship changed. And is that a trend change? So far, it looks like one to me. And so that means things like dividend payers, staples, financials, real estate, utilities. These are the ones that people are favoring since June. Now, we did have a great bounce in this tech. Look, don't kid yourself. We just had a very nice bounce. But that's after we did what? We had a pretty good switch the 90 days before. June, July, and August were pretty darn good for those ones I just mentioned. And that's coming off of Mount Whitney here a little bit, isn't it? Okay, so that's why people are interested in the other type of stocks. There's your evidence right there. Okay, now let's talk about large cap, small cap. And there you go. Laura, well, this one, I guess it was really wild back at the .com thing. Yeah, I guess that would be. Here, that's not telling me too much. There's 2020. And so again, small caps haven't done very much, but they tend to do pretty good sometimes coming out of a cycle. But that's not telling me too much. So this particular relationship not that helpful. How about the NASDAQ versus the S&P? Because everybody well, that doesn't look so good, right? Because here you go. In 2021, we were way up here. And now we have done what? Of course, they've changed the S&P around a bit, to put more tech in there. So it's not that much of a difference to the NASDAQ as much as it used to be, because, they take out what? They took out, I forget, American Airlines or something, and they put in Palantir and they put in Dell. So obviously they're weighting the S&P, and obviously, so that might be a factor. But anyway, that thing's pointing down, and that looks like a rally that failed to take out the old highs. So I don't know what that means, but it does look like the S&P, looks like in better shape based on that thing. What else you have here? Yeah, this is one. People say go international, right? Go international. Well, here's why they're saying go international. Because international stocks are as cheap as they've ever been in the US ever. And look at this was the .com stuff, right? And even then it wasn't like this. This is off the charts, right? So the bottom line is that's why people think there's value to Europe and value to Latin America and value to Asia and the Pacific Rim and value to India and places like that, because the relationship between our stocks and the world is very, very high. And of course, when we drop our interest rates, that can help their local currencies over there. It also can help with tightening up the interest rate differential that has been choking them up. And of course, the dollar's gone from 114 down to 100 on the dollar index. That can't be unhelpful for those people. So the bottom line is there's a lot of reasons. So that's why each week in my update, I always give an overview on how those international markets are going. And I use some of the ETFs in each country to illustrate my point. And again, like I told you last week, I started to really emphasize this China thing. And this week is, at the end of last week, really was a nice movement. Okay, here's one that gets you. Okay, this is home prices and the relationship of your income. Now, this is why anybody who walks and chew gum should realize that the home prices have some vulnerability to them. And let's see if we can get it here. Okay. Now get this. This was the housing bubble of 2008, right? This thing went all the way up to in 2022, which is basically the time the markets were turning over. And now we're right back at the worst income to home price relationship, which means affordability, right? And so would there be risk in real estate up here as far as residential homes? I would think there could be. And imagine if the unemployment rate would jump. That's why he's petrified of the unemployment rate. Consumer spending is 70% of the economy. What would happen to your income? What would happen to home prices if their qualifying went down because their income got cut? It could be a rough racket. So there's a reason. It's not a passing fancy, because they've created quite the monster here with all these inflated asset prices. That's quite the monster they've created. Okay, anything else I see here that might be interesting? Yeah, that's about it. Okay, so let's see if I can go back to where we were. There we are. And now I'm going to show you a couple of markets that I have been keen on here and that I try to update with my weekly updates, which I'll tell you how you can get in about 10 minutes. All right, this is the FXI. And let me show you how I came up with this idea. First, I go to the 20-year graph like I do on everything. Okay. What's the low here? RSI 23. What's the low there? 35. That means the selling's dried up. Right. And now it's got above the red line. Right. And that's when I sign up. So I think the call options down here look like they could be attractive. I don't know how far it's going to go. It could stop at the blue line. It could stop anywhere along. But I thought taking the shot here made some sense. Now, go to the 5-year graph. Now that blue line looks like the trend's turned up. The green and the red look like it's turned up, and now we're above purple. So could this thing pop all the way to 34? It's possible. Okay. But again, it peaked up here and then went in the tank. But again, it does look like it's getting more constructive rather than less constructive. And there's a lot of, and again, what do we know from our history? Things don't always stay the same. You know, things look terrible for Meta not that long ago, and it was at $100. Now it's at $500. Let me show you an example of what I'm talking about, how things can change. That movie, The Big Short, there was a couple of guys who their whole trading thing was people don't think, you know, bad things will happen or the opposite things will happen. So options are priced very low if you're looking for the total contrarian deal. Good news is when you're wrong, you lose a smaller amount of money. When you're right, you can make quite a bit. So that's the whole idea of going with things that haven't happened yet. Okay, look at Meta just so you get that idea of what I'm talking about, how things can change. It's hard to believe how cheap Meta was, right? Look, this is in 2022, right? It went down to under $100. Okay. Once it got back above here, you see these lines crossing? That tells you it's turning. Okay. And it's turning. So anywhere around here and here, you just ride it. And every time it pulls back toward it, if you want to take a shot, you can take a shot. Now, do you want to start buying it up here? Maybe not. Why? Because it's very far away from its averages. And it is set up for what? Reversion to the mean. Maybe it won't revert to the mean. I know if I had started buying it, it would revert to the mean the next day. But, you know, again, it looks wonderful. So if you're in there, God bless you, enjoy it. The trends are totally up. Okay. But look how low the RSI is compared to where we are here. Now, if we're going to go 6,000, 6,100 on the S&P, then this RSI will start screaming again. And it could very well do that. Okay. Again, this thing is off to the races up here. But, you know, why didn't we pick it up at 500 when it was a good time to buy? You see, that's what I'm talking about. But if you know, do your selling when it's way away from the averages, it reverts back sometimes, right? So my point was that, you know, things change. And it wasn't that long ago, you know, just in the beginning, what? That's not even 2 years ago, not even 24 months ago. It was trading for $100 and it had fallen from 400 to 100. People probably thought Meta's never going to do anything. And look at it now. It doesn't always happen. But if the winds of change start blowing, sometimes they blow for a while. That's my point. Okay. So I thought that looked pretty good. So FXI was a pretty good one. I thought this one looked pretty good. And this is Freeport-McMoRan, which kind of ties into the China deal, because if China can turn their boat around, you know, copper will probably be needed. And we've got infrastructure all over the place and these data centers and everything else. I think they need copper. So I thought copper was a pretty good deal down here around $40. Now, again, I don't like the red line pointing down. Of course, I don't like that at all. But on the 20-year graph, I think it looks okay. Yeah, you see it hit the 40, red line's pointing up, green's pointing up. 40 is your key. And obviously being up at 45 is not a negative if you're bullish. And on your 1 year, again, where's your low here? 24. Where's your low here? 49. Sign me up as soon as the red line turns up. So again, I don't know how far it's going to go. There's a gap there, but it certainly was worth a bite when it turned up. And another metal one is Newmont Mining, which has kind of been a mystery because gold's up there at 2,600 and whatever it is. And this thing used to be $85, but it's been a nice train, you know. I mean, this is where it turned up. So, you know, uppity, pulled back a little bit. Remember, I tell you, if the blue line and everything is not pointing down, this could be very temporary. Even if you kicked yourself out, you come right back on the train at 42 and you're riding the train. See, comes back. That's where you want to do your buying against the lines, Up here, you know, it could be in the acceleration phase. And if it is, you know, you can try to jump into that. But that's more dangerous than getting it on the dip. And again, if you go back on a 20-year graph, there's a lot of real estate that it could make up, because this used to be the high. But again, you know, in your 40 to 45 neighborhood was really the loading zone, you know? This is kind of like you plant your seeds and now you've got your harvest type of thing. Bitcoin, you guys are into a little bit here. So let's go look at all Bitcoin, because I think this is pretty exciting. See, the thing is, the fiat currency guys are at it again, meaning the central banks. They got you know, ridiculous spending, and the revenues aren't coming in, so they're gonna have to print money, right? And the central bank liquidity index is rising, which means that can be good for Bitcoin and gold. It's one of the reasons that would underpin the price. So on Bitcoin, okay, where are you, Bitcoin? Right there. Here's how I've been reading it. I've been reading it is that this neighborhood is very important. Okay. I mean, this is a critical time for your old Bitcoin, because you see, you got the red and the blue's pointing up, and so is red turning up. That ain't bad. And the green is pointing down. That's not good. But boy, if we went to 70 or 75, all these babies will be turned up. So the bottom line is, I've been saying that this 60, well, I guess it would be like 61 to 65,000 area is really the big juncture, because look at your RSI. It's right there at 53. Okay. When it goes to 60, 70 or whatever, you'll be up at 75, 85 on Bitcoin, if that happens. But conversely, you're right on the line here. So if this baby starts breaking under 60 grand again and 55 grand, you can stick a fork in Bitcoin. So my view is you got a very binary outcome. If you start closing above the 65,000 area, and these, see, don't forget, when you closed above it this time, look where the red was pointing. Pretty much down, right? So again, now you got the red pointing up. How do you know that? Well, because right there was Monday of the 9th, and the RSI was, excuse me, the moving average was at 69.95, and today it's at 61. So we've gone up about $1,000 on the short-term moving average. That's evidence of a turn. So again, why would it take off like crazy and go nuts on the upside again and blow out these highs? Because the central banks are easing money and credit into an environment of high asset prices. These, and again, supposedly gold and Bitcoin have a somewhat finite supply. And if we know anything about paper currency, it doesn't seem like there's any finite supply there. So that's something to consider. And some of the things that could benefit if that happens would be, and I do mention this in my weekly updates too, would be your coin. Let's see what that looks like. Okay. Lows here, 46, 37. Okay, coin so far has not joined the party on this at all, really. It is turning up a little bit here, but there's a lot of resistance up here. So coin is premature. How about MSTR, where the guy borrows money and then buys Bitcoin with it? That's a pretty aggressive guy. And his aggressiveness is paying off. So this one would really be more of a proxy, it looks like, a pure play, because this guy owns a lot of Bitcoin. And again, he's the guy who borrows, issues bonds, and then takes the revenue and buys Bitcoin. So that is a pretty leveraged play, I would say. And you can see in the past, now this had a split, you know, a split, I think 10 for 1. So the bottom line is this thing went up here, and look at this run in 24. Nothing wrong with that. Big drop. So it's a volatile deal. It just went down here, but it does look like the train is trying to turn. And again, sustaining above 130 is the key. The longer it stays above 130, these averages will start turning up. And then IBIT is the big thing here. And again, you can see that's trying to turn up. So the two best ones that look like would be your MSTR and your IBIT. If we were going to have that, melt up that some people are thinking is going to happen by the end of the year, well, you know, it is starting to go in that direction, so it's not as far-fetched. All right, I didn't get a chance to go over everything, guys, but I do have a weekly update and a options alert. Now, here's the deal. Many of you need to learn more about options, and basically we have an options master class. I believe David's putting up a link and everything for you now. Am I right, David?
Yeah, it's optionprofessor.com/options alerts.
Yeah, and you have the link up there that they can
Yeah,
click on, or?
yeah.
Okay, good. So anyway, here's the skinny, guys. I've been doing this a very long time, and I feel like I'm very knowledgeable about the subject matter. So I have come to the conclusion that there's two things that people would like to see. One is they'd like to know more about options. What we did there is we came up with an options master class that we hand out for free when you become a subscriber. What's in the master class? 3 sessions, 6 hours of very comprehensive information on, the option pricing, the option strategies, your alternative moves when you have an option strategy, and all types of stuff you'd want to know if you were going to do options. So you understand better the use and the risk of all the strategies, as well as options in general. So that's very helpful, and that comes to you free of charge the same moment that you click the subscribe button. Second thing is people like ideas. And obviously, I hope you understand now that I follow all the different markets and I have for many decades. And so I can jump from one market to another. And what I do each week, I try to come out with some ideas that I think look good. People can look at the ideas and they can either agree or disagree. They can change the strike prices and expiration dates. They can do whatever I want. But what I specialize in is the strangle strategy. Why strangle? Because if I can buy a call and a put on the same on the stock, same one stock, and have it boxed in at a fair price, and we get volatility, well, then I've got limited risk if I'm wrong at a reasonable price. And of course, this is all my opinion. And then if you get volatility, these premiums can expand dramatically. And it doesn't always work, but when it works, it can work pretty big. Like on a firm, like on Google going down to 148, like on Apple going down to 195, like August 5th when everything tanked. Imagine if you had a strangle during that period. What do you think the puts did on IWM when you go from 230 or 220 down to 197? They do good. What about, and even on things that I like the China deal, I'll still put a combo in there because what happened with Intel? I thought the darn stock was going to go from 32 back to 36 after earnings, but I threw a 28 put in there for 50 bucks. Next thing I know, it's trading at 19 and the $50 put's going for 900 bucks. That's why I do strangles, okay? Because I've been around long enough to know that what? You can be totally wrong on these things, and if you have a strangle on, you can still come out okay. What's the big risk on strangles is dead in the water. Time goes by, you don't get the volatility, and then you would lose the premium. What's the upside? Volatility hits. What makes the market volatile? Well, how about the earnings that start on October 11th? That could be news that moves the markets. It did last quarter in Q2. So again, we try to look for news and events that might move the markets or a sector that might be moving. Like we looked at cybersecurity and we saw Zscaler. And Zscaler had to move from like 170 up to 202. Of course, it collapsed afterwards. But again, this is not it's not hit and sit, it's hit and run. These are relatively short-term options, not zero-day options, but relatively short-term. So anyway, on your screen, to close it out, if you'd like to get started, we got a special rate, 97 bucks. You'll get the masterclass right away, and every Sunday in your inbox, in your email, you'll get my ideas and overview on all these markets that we're talking about. So you get a lot of information, and at 97 bucks, that's kind of a joke. And you can't even go out to dinner for 97. So my suggestion is you give it a try. If you don't like it after 1 month, you hit unsubscribe and you're done, and you walk away with the course, and you walk away with a month's full of information. Not a bad deal. So again, click on that link that David has up there, and let's get started. My email is optionprofessor@gmail.com. And so if you have any questions for me, all you got to do is shoot me an email. I'd be more than happy to help you with it. Okay. So again, if you do join on board here, you'll get the information in the inbox today. And if you do, I want to welcome you aboard. And feel free, like I say, to call me, to email me if you have any questions. Okay? Thanks a lot for being with us. I'll be back again. Obviously, we've been doing this for a long time. We love sharing our information. So thanks for being here, and I'll turn it back over to David now.
All right, thank you to the option professor for his insights today. And just a reminder too, if you want to check out the seasonal trading tool that I talked about at the beginning of the show, that's you can find a link at TimingResearch.com/Seasonax, SEASONAX. And the option professor, you can get his alerts.
Ariel, what happened upstairs? I don't know.
Okay, sorry about that. Option Professor alerts at optionprofessor.com/options alerts. And then of course the archive for this will be available on TimingResearch.com as soon as I can get it processed. Thanks, everyone.